Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all the financial mumbo-jumbo companies try to hide from us. So get ready for Aeries Technology Incorporated's latest quarterly report. It is a wild ride with some interesting numbers that might just tell us if they're flying high or running on fumes. Before we dive in, if you love getting straight insights from these financial filings without all the corporate fluff, make sure you are subscribed. And hey, we've built a fantastic community over on Discord where we break down these reports even further. So join us there, link in the description. All right, let's get straight into Aeries Technology Incorporated's report for the quarter ending the 31st of December 2025. This is essentially a quarterly checkup on how the company is doing financially. First up, let's peek at their balance sheet. This is like a snapshot of what the company owns and what it owes at a specific point in time. Looking at the numbers from the 31st of December 2025, we see their total assets are around $41.9 million, and their total liabilities are a bit higher at almost $42.8 million. This immediately tells us they have more debts than assets, which is what we call a deficit. And if you look at the shareholders' equity, it is a negative number, a deficit of about $1.2 million as of the 31st of December 2025. This is not a great sign. It means if the company were to sell off everything it owns today, it still wouldn't be able to pay off all its debts and obligations. Now let's look at how they performed in terms of making money. For the 3 months ending the 31st of December 2025, their revenue was about $17.5 million. That's a slight dip from the same period in the previous year, down about 1%. Their gross profit, which is what is left after they pay for the direct costs of providing their services, was about $3.3 million for this quarter. That's down quite a bit from last year, a drop of about 17%. This means they're making less profit on each dollar of service they sell. And the reason for this dip seems to be that their costs went up while their revenue barely budged. The really interesting part here is their selling general and administrative expenses. For the 3 months ending the 31st of December 2025, these expenses were about $2.6 million. That is a massive drop of 72% compared to the same period last year when it was nearly $9.2 million. This huge decrease is largely because they recorded a much smaller amount for expected credit losses. Basically money they thought they might not collect from customers. This could be good news if they're getting better at collecting payments, or it could mean they set aside too much last year. As a result of these cost reductions, their operating income, which shows if their core business is making money, swung from a loss of over $5 million last year to a profit of about $772,000 this quarter. That is a huge improvement. However, when we look at other income and expenses, things get a little murky. The change in the fair value of their derivative liabilities, which can include things like options and warrants, caused a significant hit. They had a loss of about $652,000 here compared to a gain of over $5 million the previous year. This swing dramatically impacted their net income. Ultimately, their net income for the quarter was about $1.2 million, down from over $2 million in the same quarter last year. So while their core operations look better, other financial factors dragged them down. Now let's look at the bigger picture for the 9 months ending the 31st of December 2025. Their revenue was about $50.1 million, down slightly from $51.1 million last year. Their gross profit, however, actually improved to about $12.1 million from $11.6 million last year. This is good news, suggesting they are becoming more efficient at delivering their services. The gross profit margin also improved, which is a sign of better profitability on their services. And just like the quarterly report, their selling general and administrative expenses saw a massive reduction. For the 9 months, they dropped by a whopping 77% to around $8.6 million from over $37 million last year. This is largely due to reduced stock-based compensation costs and a significant cut in expected credit loss provisions. This cost cutting and improved gross profit led to a much healthier operating income. They swung from a loss of over $25 million in the first 9 months of last year to a profit of about $3.6 million this year. This is a significant turnaround. But again, those changes in fair value of derivative liabilities played a big role. This time around, it resulted in a lower other income compared to last year. All in all, their net income for the 9 months was about $3.6 million, a huge improvement from a loss of over $15 million in the same period last year. This looks like a strong comeback, but we need to understand what is driving these big swings in other income and expenses. Let's talk about cash flow. This tells us how much cash is actually flowing in and out of the company. For the 9 months ending the 31st of December 2025, they generated about $4.8 million in cash from their operations. That's a big jump from the previous year when they used about $1.9 million in cash from operations. This indicates their core business is generating more cash now. On the investing side, they used about $1.2 million for things like buying equipment and making loans to affiliates. This is pretty standard. Financing activities show how they're managing their debt and equity. For the 9 months ending the 31st of December 2025, they used about $3.7 million in financing activities, mainly to pay down short-term borrowings. Last year, they actually brought in about $3.3 million from financing, likely due to issuing shares. Overall, their cash balance ended at about $2.6 million, a slight decrease from the beginning of the period. While they are generating more cash from operations, the debt payments and other financing activities reduce their overall cash pile a bit. Now, let's talk about something called going concern. This is a pretty serious term in accounting. It asks if the company can stay in business for at least the next year. The report explicitly states that there are conditions that cast doubt on their ability to continue as a going concern. One of the big reasons is this working capital deficit of over $7 million. This means their short-term debts are higher than their short-term assets. A large chunk of this deficit is due to something called forward purchase agreements, totaling about $4.1 million. These were arrangements made during a business combination, essentially promising future payments or shares. The company doesn't have enough cash to cover these if they were all due today. They are trying to fix this by cutting costs, especially non-essential ones, and renegotiating terms with those FPA holders. They've also mentioned raising more funds through loans or selling more stock. But here is the catch. There is no guarantee these plans will work. This report mentions warrants, which are basically options that give someone the right to buy company stock at a certain price. They have a lot of these warrants and they are classified as liabilities, meaning they represent a potential future obligation for the company. The value of these warrants can change, affecting the company's overall financial picture. They also talk about legal proceedings, saying they're not aware of any major ones right now, which is good. But they do mention commitments related to these exchange agreements for shares of other companies they acquired. And here is a pretty big risk factor. Their stock price has been below $1 for a while, and they're at risk of being delisted from the Nasdaq. This would make their stock much harder to trade and could hurt investor confidence. They have until March 2026 to fix this, but it is a serious concern. So, what is the story here? Aeries Technology Incorporated seems to be getting its operational house in order. Their core business is generating more profit and more cash than before, and they've made significant cuts to their operating expenses. This is a positive sign for their long-term health. However, they are still carrying a lot of debt and have significant obligations from these forward purchase agreements. The uncertainty around how and when these will be settled is a major risk. If they can't find a way to manage these liabilities, they could find themselves in serious financial trouble, even facing delisting from the stock market. The improvement in their financial performance is encouraging, but it is shadowed by these substantial financial obligations and the ongoing risk of delisting. They need to execute their financial restructuring plans very carefully. That is our decode of Aeries Technology Incorporated's latest report. What do you think about these numbers and the company's future? Let us know in the comments below if you found this breakdown helpful. Please hit that like button, it really helps us out, and subscribe for more deep dives into corporate finance. And don't forget to join our Discord community linked in the description. Thanks for watching, and we'll see you in the next one.